Hello, everyone. Welcome to the final bar. Today, my guest is Ryan Detrick from LPL Financials, helping us hopefully make sense of this market that continues to confound. We have big rallies into the close yesterday, a sell-off into the close today, based on some news from the Trump administration. So, at the end, it's all about the charts and where we're seeing the long-term charts evolve, and hopefully that's where we'll be able to focus today. Also, a special focus on breadth characteristics and how they've been changing. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at the charts together, try to read the markets from a technical perspective, make sense of things, and then connect the short term to the long term. And again, the goal of this show is to focus on the long-term trends, how those momentum shifts are evolving, focusing on inflection points, but making sure we key in on the long-term implications of the short-term movements. I want to start with a bit of a serious note. We lost a technical analysis pioneer this week, Gerald Apple, who created the MACD indicator, moving average convergence divergence, and the PPO is something that a lot of our users use, myself included, and my main trend following model is built on PPO, which is using a MACD, but with percent changes instead. He passed away this week. It was pretty up there in age, and hopefully it was a good thing overall. But we will certainly miss him and value his contributions to the technical analysis toolkit. His son Marvin Apple has continued on his work for a number of years, so hopefully we'll see more and more from him over time. So rest in peace, Gerald Apple. Let's get to our schedule coming up. We have a lot of fantastic strategists helping us make sense of this market environment. And Ryan Detrick, as I mentioned, is one of my favorite strategists. I love people who are technically oriented, but can think about other things and talk about how they relate to the big picture and themes that we're seeing evolve. Going into next week on June 2nd, we have Peter Brandt. On June 3rd, we have Frank Capillari from Instinet. And then the next week on June 9th, we have Dana Lyons and Mark Ungewitter joining us on June 10th. So some repeat guests that did such a fantastic job. We're really excited to have them back on the show and get an update on what they're seeing here. Also, as a reminder, Behind the Charts, featuring our conversation with Ralph Acampora, focusing on his experiences, learning the technical toolkit in the 60s and 70s during the end of a secular bull into a secular bear, fairly timely for some of the volatility and the uncertainty we've seen now. So that's our next episode of Behind the Charts, coming up this Monday, June 1st. Let's get to our market recap. And as you probably know, we actually run polls on our StockCharts TV page all the time. So if you go to stockcharts.com/TV, if you're not there already, you'll see a live poll. And we also put some out on our YouTube channel as well. What we recently asked you was, what time frame do you use the most for your charts? 66% of you, 2/3, said daily, followed by intraday, 17%, 12% weekly, 5% monthly. And that is okay. I accept that answer, but boy, I would love to see people thinking more along weekly and monthly timeframes. And even if it's not, we asked you what you use the most, and that's probably fair, but don't forget those of you that do use the daily charts the most. And on this show, we often do, just because we're talking about short-term fluctuations. And so I think that's the way that it makes sense to look at it. Don't neglect those long-term charts. Comes to mind my interview with Katie Stockton yesterday, focusing on a weekly chart, monthly chart of the S&P and looking at the monthly MACD indicator. There's a lot to be gained from looking at those long-term perspectives. Don't lose track of those of the big picture when you're focusing on the day-to-day movements, for sure. Let's get to our market recap. This week has certainly been 3 days now of violent swings into the close. The S&P sort of moving higher, chipping way higher, almost at the 3070 level earlier in the day. Actually finished back on a downstroke. So finished down in the red, down 0.2% to just below 3030. So still above that key 3,000 level that we sort of eclipsed this week, but coming off into the close. And obviously there's some headlines about U.S.-China relations, headlines about Trump and things with Twitter and Facebook and social media. So there's certainly plenty of uncertainty out there. But again, focusing on the charts coming off. And it's not just the mega caps. I think if you look at small caps, they're actually down for most of the day. So they finished negative and really accelerated into the close. So the S&P 600, the common small cap index, down over 3%. Mid caps almost 1.5%, but both led the way lower. So this is after earlier in the week we had small caps leading the way, and the small cap relative performance starting to improve. Today, giving back a little bit of that relative performance. The Nasdaq 100 tied obviously to technology, finished a little below zero, and the tech sector sort of a market performer day, down 0.2%, as well as the S&P. In terms of other sector themes, you had sort of a move to defense toward the end of the day there, with utilities, real estate in the top three, and healthcare, which has been sort of at the bottom of the list in recent days, back up to the top. On the bottom, we have financials and energy. Financials certainly have been the top sector, if not close to the top, in the last couple days. This week has seen big jump higher in a lot of the banks. We looked at some of the banks yesterday, Goldman Sachs, Bank of America, if I remember right. But the XLF down about 1.5% today. Consumer discretionary third from the bottom. So what does this chart of the S&P look like after today? So, again, a bit distributive in that we open, close below the open. We closed below yesterday's close. Again, focusing on the long-term trend. The trend's still remaining positive. That break above 3,000, pretty meaningful. And I think if we're able to hold that 200-day moving average, certainly suggests potential further upside from here. And as we get to our conversation about breadth a little later, we'll look at the breadth characteristics now versus some of those, bear market rallies coming out of the lows, and certainly, you could see further upside from here in stocks. That's totally valid. Now that I think we've sort of broken out of that resistance range. For me, it's all about the follow through. And again, the reason why I'm hesitant to just say long and strong S&P 3400 is pretty much a certainty. Because every day when we have that thrust higher, we sort of have this pullback that makes it feel not quite as good. The distribution into the close today maybe is part of that, closing down today. So it wasn't, sort of the upside follow through. But again, overall, as long as we remain above the 3,000 level, remain above this resistance range that we were toying with for, 4 to 6 weeks, I think we're pretty much in positive trend mode for sure. The RSI remaining above 60, which is more in the bullish range for sure. Looking at some of the key stocks, key themes, it's worth noting not a ton of change with the top ranked stocks on the Scooter reports, except to note that one of the more defensive plays, Newmont Mining, which is a gold stock and certainly not thought of as traditional leadership, has been in the top couple stocks in our Scooter rankings for a while now, since the bottom, now dropped off the top 10. Others pretty consistent though. So things like NVIDIA, so you have semiconductors are represented here in a couple places, consumer discretionary in the form of Tractor Supply Company, you have PayPal, so a payment processor, biotechs, Regeneron, ServiceNow up there as well. So a lot of consistent names that we've been looking at historically, but certainly a bit of a rotation with some of the more defensive things kind of popping off that list. In terms of industry groups, the top 3 industry groups today, all in utilities. That is not what we would consider a bullish configuration of industry returns for sure. And then in healthcare, you had things like pharmaceuticals, maybe more defensive part of the healthcare sector, less biotechs, right, which would be more considered more on the offensive side of it. Also consumer staples represented in the top 5. So some of the defensive groups actually up pretty positive. The relative strength on utilities, most people have been ignoring for a while for good reason, but a nice up day, up 3% today with a healthy dividend. And again, any sort of pullback, you'd certainly see those groups start to do better and better. On the downside, this is where the financial sector really got dragged down. Mortgage finance stocks down almost 8% today. Within consumer discretionary, you had a bunch of groups down 4 to 5%. And look at the cluster, these home construction, hotels, gambling. So we're sort of back to risk off mode. Airlines down here as well. So, it's worth noting with some of these groups that it's sort of feast or famine. They're one of the top 10 or bottom 10 groups, I feel like, every day. And it's whether, these sort of risk on names are sort of getting back onto the positive side, or today it's more of a downside with hotels coming off. But again, all of those groups now have had a nice run out of the lows. Even airlines, some of the airline charts have improved dramatically from from even a week or two ago. So this was just one down day. But again, the reason why I pointed it out here is just to remind you that long-term trends are made up of short-term movements. So if you can focus on some of those rotations, potentially get ahead of some of the turns as they're happening, I find that's always pretty helpful. So the question going forward here, as the S&P, is it able to hold up here? Do you see defensive groups like these utilities groups, rotating to the top of the industry list through the rest of the week? Do you see financials, sort of recovering from today, which is a bit of a pullback in a lot of ways, and especially consumer discretionary, which has been a bright spot, definitely outperforming consumer staples over time? Does that do we maintain that relative strength? Here we actually had consumer discretionary down, consumer staples up. One of the ratios we've looked at a lot of times is that relative movement of consumer discretionary versus staples. I tend to talk of it as sort of offense versus defense. Remember, this down day we had is this little blip here. Overall, the trend has certainly been favoring consumer discretionary. So this would be early on to think anything is changing, but I think that's where you want to keep an eye on a chart like this as it starts to roll over, suggesting a move toward defense. In this case, I think the positive trend certainly still in play after this week's breakout. Want to take a quick commercial break. That's our market recap for today. We'll come back with my guest, Ryan Detrick from LPL Financial. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. Thanks for joining us for the final bar again today. As a reminder, we'll have another mailbag segment tomorrow. So if you have any questions about the charts, about technical indicators, about particular sectors, stocks, whatever you're looking at, we'd love to help you on this journey of learning the technical toolkit, empowering you to make better decisions. So shoot us an email, thefinalbar@stockcharts.com, or on Twitter, just tag us in a post @FinalBarSCTV. We'll gather all of those. And again, we'll have another segment tomorrow. We'd love to answer one of your questions on the air. I want to welcome on my guest, Ryan Detrick. Ryan's from LPL Financial, joining us from North Carolina. Ryan, welcome back to the show, my friend.
Dave, thank you for having me back. I'm honored to be back on the final bar. Should be a lot of fun.
So, obviously I feel like every time we would talk, it's sort of an interesting time in the market, but, I know a lot of people have been questioning bear market rally. Are we at resistance? And then this week feels like we're starting to get some upside follow through. What is your toolkit telling you about the current environment here?
Yeah, you're not kidding, Dave. We just had 40 days off of the March 23rd lows. And that was one of the greatest 40-day rallies in stock market history. What have we done? The 5 or 6 days since then, go up every single day again. So it's amazing. But what the first chart I wanted to share is just put in context, this initial rally off those lows. Up over 35%, as you can see, one of the strongest initial rallies off of a bear market low we've ever seen. Now, the reality of the fact is this isn't going to happen forever. At LPL Research, we're looking at seasonality. We're looking at this stretched market. A pullback could make a lot of sense. And that's on the right. After the initial rally off of major market lows, you see about a 10% correction on average. Now, I am aware there's no such thing as average, especially in this crazy year of 2020. But I just want to make sure people are aware that there will probably be a pullback sometime this summer. It might be as much as 10%. And it's perfectly normal is, I think, the key thing we want to point out here.
It's interesting, and it's funny as people think about pullbacks. I feel, it feels like a skittish market, right? People are either, we're going to the moon or we're going to zero. And 10% down puts us 2,700-ish. I think that's gonna hurt for a lot of people, probably mentally more than anything. Now, what about the breadth characteristics? This is something coming off the lows. I know the breadth characteristics have evolved a great deal. What are you seeing there?
Yeah, this is obviously the percent of stocks above the 50-day and the 200-day down at the bottom there. And what we looked for is we were in the camp. We started in the camp back in, middle of April saying we're not going to retest the major lows. And we were looking at that 200-day at the bottom. Once that gets up above 15% or so, that's usually the hallmark that the lows are in. And again, anything can happen. But sure enough, since then, we've had a continued rally. But what I want to focus on more is the 50-day. Over 90% of the stocks in the S&P 500 are currently above their 50-day moving average. That's a blast of strength. And we know what's going on, right? The previous leaders did great. And now some of the laggards, like you just talked about before I came on, have started to do well. So the majority of stocks are above their 50-day moving average. What in the world does that mean? Well, let's go to the next chart to kind of show that. So I took a look at all the times, going back to using StockCharts data, all the times going back to 2003 when we had that initial spike above 90%, with 90% of the stocks in the S&P above their 50-day moving average. It's kind of one of those, it is what it is, Dave. You can see there 6 months to 12 months later, really strong returns. I mean, only once was it lower a year later, and that was, 2000, really, I guess you could say the U.S. debt downgrade in August 2011 caught that one. All the other times, a year later, you're looking at really strong returns. So in the near term, sure, we have some concerns. But when I see this much strength, off of major lows, to me, it suggests, again, 6 to 12 months from now, when we look at it, stocks are probably going to be a little bit higher, maybe even a lot higher if you look at this one historically.
And I think people are programmed when they see such a spike in a breadth reading like that, they just automatically think of it as negative, right? They're programmed, I think, in some ways to think of it as being overbought, like we've gone so high, so quick, we need to come off. But if you have a long enough runway, it seems like this is actually more of a positive thing to see this sort of breadth participation right out of the lows.
Yeah, we agree. And when you consider 0% of stocks were above their 50-day back in the middle of March or right around that third week of March, you were historically oversold. Now you're historically oversold. Again, a hallmark that you see off major market lows and normally suggests there could be more upside.
So your last thing that you sent was about COVID-19 test results. And we were chatting before we went live. We're here in Washington State. You're in North Carolina. I think even so far, our experiences with what's happening in terms of reopening and our worldview is probably very different because of where we're at physically. How is this relating to what you're seeing on the charts in terms of how this has evolved?
Yeah, I mean, I'm obviously a technician at heart. I have my CMT, but I do like to look at big macro views. And one thing real quickly about Charlotte, we're getting rain every single day. So that's one place maybe where we're about the same as Washington State. We're getting a lot of rain. But, one of the key things we said at LPL Research off the lows was we needed to see more testing and we needed to see it significantly. And this is a number of tests we're seeing per day. We've been seeing over 400,000 tests a day in the United States. It was a little bit lower recently due to probably the holiday. But that more important line, Dave, is that green line going down. That's a number of positive tests that we're seeing as a percent of all the tests. And we just hit recently another new low there. So as long as that stays low and we continue to do more and more testing, how are we going to beat this thing is more testing to find those people that are sick, to keep them inside and to keep them away from other people. And eventually we'll get a vaccine. I know that. And I know I'm not talking about technicals right now, but still, if that green line keeps going down, it is hard. And the blue, the more testing, it's hard for me not to think the stock market's a forward-looking mechanism. And it's saying, okay, better times are ahead on the economy. And again, as the other slide showed, I think the stock market can keep on going higher 6 to 12 months from now.
So it's interesting. We only have about 30 seconds left, Ryan. This has been fantastic, but I'd love to know, when we're looking at a chart of the S&P, so certainly, and mine's a little busier, sorry about that, but, as we're moving forward, I certainly get the idea that, that things seem constructive. You talked about the potential for a 10% decline that would still fit into that long-term thesis. Like, what would you be looking for here that would tell you, okay, the uptrend is over, we now need to back off or just get a little defensive? Is there a key level or a key signal that you would identify in a chart like this that fits with your methodology?
Well, yeah, 2650. I mean, I see you've got 2650 labeled there, the 38.2%. I mean, that's kind of one area that we think is a nice, tasty area to go down to. If we go much beneath that, we'd be a little more concerned. But just bigger picture, when we see that much breadth and that much strength, I mean, it's going to be scary when that pullback happens, but it's going to be a buying opportunity in our view.
Ryan Detrick, this is such a pleasure to have you back on. Really appreciate it. Hope you and the family stay safe there in the Carolinas, and look forward to having you back on again soon. All right.
Appreciate that. And I have to say, go Bucks. Thanks, Dave.
I will accept that.
There you go.
It, Ryan. Thank you.
See you. Thanks.
Ryan Detrick joining us from LPL Financial. And again, I hope what you saw there, it's so interesting. We talk about breadth, and it's a perfect time to have Ryan on and rotate to a deeper discussion about breadth characteristics. I think a lot of times people are looking for a reversal, right? Looking for a signal of being overextended. And when you see a big spike in breadth readings, especially the percent of stocks above their 50-day, goes above 90% up from zero, 4 to 6 weeks ago. That's a huge move. But again, what Ryan's toolkit reminds me of is looking at the history and looking what's actually happened after these scenarios. And I've seen this talking to a number of my peers around the industry. That big move from 0% to 90+% is actually pretty positive over the longer term. Between now and then, it's about a tactical decision, and that's why I asked Ryan about just potential pullbacks and what he would be looking for. But great set of charts there, and a little market history as well. Let's go to our next segment called Banking on Breadth. What we love to do with a regular routine is look at the breadth characteristics on the market. I have a breadth chart list that I like to use for this. If you don't have a good set of breadth charts, if you go to the chart pack system on our platform, or if you create a new login, you'll be able to get to this. But if you go to your member dashboard, click on chart list there on the right. I have a bunch of these, so sorry you have to go way to the bottom. You might not have this many, but if you go to the bottom, you will see a little button that says Manage Chart Packs. If you click on that, you'll see something that's called like Dave Keller's Morning Coffee Routine or something like that. It will install a series of chart lists on your login, including this one, this breadth indicator chart list that I'm using right now. So first off, we're going to start with, breadth in the form of stocks above their moving averages. I don't want to beat this too much because I think Ryan did a great job of illustrating it, but I'm certainly looking for, the breadth increase out of the lows from 0% to 90+% above their 50-day is super meaningful. For me, I'm looking at the percent of stocks above their 200-day moving average and looking to see it break above 50%. I think that's an interesting one because if you look at the 2019 lows, up until then, that's kind of where you tested the 200-day. You finally got over half of the stocks reclaiming their 200-day right about when the market did. That makes sense. And from then, it was sort of long and strong through the rest of the year. So, for me, in sort of like a mental all clear signal, thinking, there's certainly strength for further upside. That's one thing I would certainly be looking at. But yeah, the breadth has risen a lot, and it's looking more and more like that, first quarter of 2019, to be honest with you. In terms of stocks up and down, and I'm going to just refresh this to get the closing bars in there, but we ended up, so I was going to say earlier in the day, it was over half of stocks on the New York Stock Exchange closing higher, less than half closing lower. That actually flipped going into the close, but still 42% of New York Stock Exchange listings finishing above yesterday. The S&P, of course, did not close a little bit below yesterday's close. 57% of the New York Stock Exchange lower. So again, sort of a middle of the road digestion day of sorts, which is about what the market felt like. In terms of new highs and new lows, again, we're still relatively flat because the average stock is still well within that range. For me, as you want to get more and more optimistic, we're going to look, later, some stocks that are, testing. Zebra Technologies comes to mind, KLAC comes to mind, names that are sort of testing resistance. If you think about it, it doesn't take much to get these a little bit further up, and they will be part of this group of names making new 52-week highs. They're not on here yet because they're not yet above those key resistance levels. So seeing stocks like that, especially in technology, consumer names that are at or near their previous highs, that seeing an uptick in those new high readings would certainly make me feel better about long-term strength for the markets. At this point, again, still limited upside with 3,400 maybe looming large above current levels. The breadth picture in terms of cumulative advanced decline lines certainly feeling more and more positive. This is not updated for today's close just yet. This is as of yesterday. But if you look on yesterday's close, a nice update in the mid-cap breadth reading actually broke above its swing high from the end of April. The S&P just testing it. The New York Stock Exchange just testing it. The small cap index just testing it. Based on what we've seen from small caps, I wouldn't be surprised if this kind of ticks down today, but overall, seeing them reclaim those highs from the April peak would be really compelling for suggesting further upside in stocks. A failure here would certainly be a bit of a concern. We've talked about the volume read, and I had some questions, I think, in our Q&A session yesterday, the mailbag. Someone had asked about volume. I talked about, you're right, the volume overall has been lighter. It's worth noting, like, the on-balance volume has remained fairly positive. Now, this is kind of going to be skewed positive in general if you have a ton of updays, which is what we've seen. But what you would look for is a divergence, higher highs in price, the on-balance volume rolling lower, which just means in a normal trend, you will have up days and down days. This rolling over would mean there's more volume on the down days than the up days, tends to suggest being at the later stages of a trend. We haven't seen that divergence yet. It's sort of supporting the uptrend in stocks. And then finishing off with the McClellan oscillator and then the McClellan summation index. These are created by Tom McClellan, who runs the McClellan Market Letter. His parents, Sherman McClellan is a name many of you know, created this indicator a number of years ago as an adapted form of breadth. So it's using exponential moving averages of an advanced decline reading to basically look at trends in the advanced decliners, remaining above zero and accelerating this week. So basically just suggests, weight of the evidence more positive. It had turned negative the second week in May, but reversed back above the zero line, and the summation index also breaking higher as well. So overall, the breadth readings by most measures are relatively constructive here. And, again, if you would start to see a sell-off, that's where a pullback, I think that's where you'd want to look at some of these to see if they're confirming that breakdown, if it feels more just like a short-term digestion, a short-term correction, or whether it's part of a deeper move a little bit lower. So overall, it's interesting. I think, again, the breadth coming out of the lows has been impressive. I think I was questioning things a little bit when you saw this breakdown in the cumulative advanced decline lines. They all appear to be, rotating higher, mid caps breaking above. And I think at this point, this is a key chart to watch to see if we're able to remain above those April highs, or actually get above those April highs for small caps and for the S&P right here through the remainder of this week. That's our segment, Banking on Breadth. And again, that chart list that I just used, you can download it. Just go to your chart packs from your member dashboard page. You can incorporate those, download that right to your login. We're going to finish off with a 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the AAII ratings. Katie Stockton, my guest yesterday, referred to this sentiment index. And again, it's been interesting. I've had some great feedback from a number of you asking questions about how I use this and why I use this. For me, sentiment like this fits into more of an anecdotal bucket. I like looking at softer data like surveys and flows and things because it tells me a little bit about where people's heads are at. For me, price is most important though. So I would never use this without validating what I'm seeing on price, but I think it's worth noting in the last 3 straight weeks, the value has narrowed in terms of percent bullish and percent bearish. Katie was keying in on the extreme discrepancy where there were 30% almost more bears than bulls just about a month ago. And that's lining up pretty well with the December 2019, that first week in December. That's where you had a bombed out sentiment reading as well. Since then, we sort of narrowed that out a little bit, still 42% of respondents bearish, but the difference between the two getting closer and closer to a zero. So alleviating the amount of bearishness we had just on that pullback a couple weeks earlier. Chart number 2 is looking at financials. So this has been the juice coming out of this consolidation. So about a week ago, you sort of felt like financials were in no man's land, sort of in the middle of this range for the last month. Then they spiked higher yesterday, breaking above the swing highs. And a lot of those charts like B of A, Goldman, Morgan Stanley, all having these nice, pretty breakouts. All of a sudden today, you have a bearish engulfing pattern. We saw that in some technology names earlier, some biotechs, going into the weekend last week. And so a bit of a negative signal there short-term for financials. Again, that suggests short-term weakness in the sector. And if you would break above the swing high there from today's high, that would invalidate that and suggest the uptrend is in place. So overall there, the trend's still positive, but suggesting a bit of a short-term weakness through the remainder of the week. Finally, I mentioned all of these stocks sort of testing their previous highs, not making a 52-week high, but really, really close. If I would want to look at a chart other than other things we've talked about so far, just an example stock to pay attention to, KLAC or some of the semiconductor names might not be bad. If you look, this hit a high last November, retested it a number of times. That ended up being the high in January and February. That's when we rolled over from there. We've now revisited. We've round tripped to those previous highs. If charts like KLAC are able to power through this, I think that propels the S&P further above its 200-day moving average. It makes a retest of the February lows for the S&P or March lows for the S&P less and less likely. Makes this feel more just like a cyclical bull trend that's in good shape. But if these start to fail here, all of a sudden this looks like a huge double top pattern on the weekly chart, starts to suggest a little bit of more internal weakness. So a chart like KLAC might be an interesting one to watch the next week or two. Folks, that's our show. I want to thank you for joining us on the Final Bar every weekday after the closing bell. I want to thank our guest, Ryan Detrick from LPL Financial, joining us, sharing some fantastic charts today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.